Welcome to the Retirement Roadmap by SHP Financial, a podcast empowering today's retirees and pre-retirees to make well-informed financial decisions that will help you spend more time living and dreaming than worrying and wondering. Join me, Matthew Peck, along with my co-hosts, Derek Gregoire and Keith Ellis, as we share actionable financial strategies and insights, as well as interview top thought leaders in the world of finance, accounting, and estate planning. This is all aimed at preparing you for the retirement you've always dreamed of. Our high-quality holistic planning process has helped thousands of families retire and create what we like to call the ripple effect. The Retirement Roadmap is your guide to financial freedom. Are you ready to get started? Let's go. Welcome everyone to another edition of the SHP Retirement Roadmap podcast. I'll be your host today, Matthew Peck, and I'm joined today by Keith Ellis, also of SHP fame, all 20 years, close to 20 years now, that we've been doing this now together, which is amazing and a whole topic all to itself, to say the least. But just so everyone knows, today we'll be talking about sort of end-of-year planning. We all know how difficult of a year 2022 has been. But Keith and I wanted to sit down and take you through what we are advising our clients to do. Some of the strategies that you can employ at the end of the year to make sort of lemonade out of all the lemons that we've received for 2022. What are some of the things that you can still do even though the markets are obviously in a very difficult position? And so it's like, okay, we still want to make sure that we're taking advantage of every opportunity that gets presented to us. We still don't want to sort of put our heads in the sand and just say, oh, okay, bad year, wait till next year. It's like, well, not necessarily. There may be things that you can do prior to December 31st that can at least improve on a difficult situation. And if we weren't doing this on the podcast, and if we weren't doing this on behalf of our clients, then frankly, we wouldn't be doing our job. So let's sort of talk about that today. But without much further ado, Keith, I'll bring you on. And so tell me again, how has 2022 been for you, and how's everything been in general?
Matt, you said it best. It's been a pretty tough year for the market. But, I think as advisors and as planners, and each of the families that we work with have a specific plan that is tailored to them and their situation, their goals. It's up to us, and I like what you said, it's up to us to look for opportunities to turn lemons into lemonade and really try to maximize the plan even in down years. We did a lot of this planning during the COVID year as well, the early parts of 2020, when that was a really difficult time. We took advantage of some of those difficult times and really put what we believe clients in a better position long term. So looking forward to kind of talking about some things that we're doing, like you said.
Well, and I think too, certainly this year has been, unique, or at least, maybe not unique, but it's been a long time coming, meaning that the
market can't go up forever.
Market can't go up forever, correct. And it's the length of it too.
Correct.
If you remember, you talked about COVID, right? COVID obviously was an extremely scary March and April, but soon after the fiscal response and all the stimulus, which is kind of where we are now, paying for all that stimulus right now. But that being said, the quote-unquote bear market of 2022 lasted 3 or 4 months, right? And then officially beyond then was 2018, which was a 3-month situation. Right at the end of the year,
October to December. Yep.
Yeah, exactly. It was a very short, short event. Now we have, as I said, the bill has come due from all that stimulus. So now we're kind of entering detox, which is why 2022 obviously is so difficult. But as I mentioned, it just remind everybody about the length of this. We are now officially 9 months into it, and interestingly enough, the average bear market's 18 months, so we're still below average. In the sense that if the market does somehow start to turn, which we don't necessarily expect, it would be on the shorter end of it. So it's reminding people that bear markets, as you said, markets don't go up all the time. And also bear markets do strike, and they do take time. It does take time for the wash to kind of, rinse out and for things to finally kind of stabilize. So it's just a reminder that, it's been since 2008. So we are talking close to, 14 years since we have dealt with an extended bear market.
And that's just it. You got to remind folks the run that we've had. right? I mean, it's been a really nice run. There have been some hiccups along the way, but those hiccups, like you said, have been pretty quick and pretty, and what I mean by that is quick to return back to the quote unquote norm. So, you got to remind yourself, and I always say to folks, think about the bull market run we've had. The market in a weird way kind of needed a breather.
Right.
It can't go up every single year all the time, and this is the time when, in our opinion, is the time to take advantage of a bad situation, but also to be investing, to take advantage of the down market and get assets at a cheaper price. I think it makes a lot of sense.
Well, that's the thing too. How have your clients been in general? I mean, is there our most understanding of everything you just mentioned, and certainly the advice that you're giving them? I mean, I guess what is the overall sense of alarm in the book? Is it relatively low, or is it high? I mean, I guess when you try to read the tea leaves or put your pulse on how Joe Sixpack is feeling nowadays, I guess what's your reading right now?
I mean, I think a lot of folks, once we sit down with them and we go through their plan and revisit their plan in a down market, a lot of them come out confident, confident to know that this was something that they knew was going to happen at some point.
Right.
Like I said, and I keep saying, the market can't go up forever, but to have it, for some folks, 12 to 24 months after we've built the plan, implemented the plan, and to see the plan hold up, I think it's more, I would say 90% to even higher than that, leave the office or leave the phone call or leave the Zoom meeting with more confidence. It's just looking at the headlines every day, the uncertainty every day, that can weigh on people. And until you actually have a conversation to know where you're at and be able to see where you're at, again, having a plan in place to us is one of the most important things that you can do as you exit your working years and enter your retirement years, because it gives you confidence
Right.
to spend, confidence to withstand times like this, confidence to give, confidence to just enjoy what is supposed to be, some of the best years of your life. So,
well, and I think too, and I know we say a lot of it on the, during our market updates and whatnot, but just the power of diversification too. I mean, if you had planning with diversification, and I know that's kind of old hat in regards to the diversification side, where you kind of, take the edge off and different things along those lines, but I remind people, because obviously Keith, you did a great job mentioning the planning aspect and giving people those long-term perspectives. But sort of behind the scenes, and certainly in front stage too at times, but just being diversified. Because I think people hear, or as you mentioned about those headlines, they'll say like, oh, market's done this and this is down and that's down. And sometimes they automatically think that, oh, my portfolio or whatnot must be just as much down as what that headline says, or the Dow drops this or the NASDAQ drops that. And it's like, okay, well, yes, the markets did that, but maybe not necessarily your portfolio. When we use risk hedges like those fixed annuities or bonds or any other proxies or ones that will kind of take the edge off, you realize, especially when you do these reviews, as you said, when you are sitting down with people, you're able to say, look, yes, this is what happened in the overall market, but here's how you or in your mix actually performed. And more often than not, I think that also gives them a good feeling to know that they're not necessarily falling as much as the general market.
yeah, again, it just comes back to that word confidence, revisiting that plan and, instituting that plan, and then doing what we're here to discuss today is, starting to look at opportunities as we exit 2022 and enter 2023. What could people be doing? And one of the things that we're doing internally as the year goes on is looking at money that is after tax and harvesting losses. And what that means is you're purposely selling losses, and some people will shake their head and be like, why would you ever do that, right? It's more on positions that you don't feel confident in, or maybe aren't confident in over the next 30 days, because there is a rule that is in place that you cannot enter that same position for 30 days. It's called the wash rule. And if you're confident or you have a feeling that the market isn't going to do well, or that position's not going to do well over 30 days, but overall you do like that position, you can buy it back in 31 days and take that loss And what that means is you can use that loss against any future capital gains, sale of property. I'm dealing right now with a family that sold the property up north, and they have a pretty sizable capital gain. So what we've been doing since we've been working together in July is every time there's a loss, we're taking that loss because it actually helps them and then repositioning the asset. So it's a really nice way to bank some losses, to potentially use that against future gains. And then in the future, as you need distributions, there might be the ability to get that money tax-free if you do it right. So there's some really unique ways, and we believe wholeheartedly in tax loss harvesting. Again, it's a position-by-position outlook. It's something that you want the client on board with, to educate them first and say, look, this is why we're doing this, and this is what we're thinking of doing. Do you agree? Yes. And then you execute.
Well, yeah, so let me kind of unpack that a little bit for our audiences, because I think you did a great job, Keith, of explaining it, but let's also kind of, as I said, put it in perspective, right? Whereas the whole idea of tax loss harvest, I kind of get a kick out of it because it's harvesting. It's like, okay, all right, you kind of explain that. So imagine, you have all the wheat or whatever, and you're kind of just gathering it in. And so at first it's like, okay, that sounds like a positive thing, but wait a second, we're harvesting losses. Like, oh gosh, I thought I'm supposed to stay in the market. I thought I'm not supposed to realize any type of gains or losses in that situation. But no, not necessarily, because when a bear market strikes like it is right now, you can harvest the losses. But I think what's great about it, and what Keith explained, is the fact that you can stay invested. It's not like you have to sell, position A, stock fund A, and then just sit in cash and wait for 30 days. You can stay in similar sectors.
Correct.
I mean, very often, let's just say, for example, you're in, I'll say the consumer staples area, or let's say you have Procter & Gamble as a stock. Okay, well, you can sell Procter & Gamble and then, invest in Walmart or in Kellogg or whatever that may be, as an example. And so the individual now, any losses that they had in Procter & Gamble or in that stock, they're now able to use against, as Keith mentioned, maybe it was a sale of a property. Maybe they had sold, a second home or a rental home that they had given in this particular year. But also what I love about it is the fact that you can carry it forward. Mm-hmm. So it's not like, oh, okay, let's do it because you did have that sale of a property. Not necessarily, because if you harvest, $20, $30, $40, $50, $60,000 worth of losses, you can take that year over year. And whether it's using against, your taxes at roughly about $3,000 per year, or whether it's a future sale of a property. So as you mentioned about a client that sold their home in 2022, but they might sell their home in 2025, and you can carry those losses forward. What you've harvested, what you've brought forward, or what you've actually kind of put in your piggy bank, if you will, you can use both this year and ongoing, every year ongoing.
It's an important strategy and something that you should be addressing, whether it's someone that's doing it themselves or you're working with an advisor. You shouldn't be bringing it up to that advisor. That advisor should be bringing that strategy to you, but nonetheless, the strategy should be executed if it makes sense for the investor. And then another strategy we're looking at right now is the ability to convert IRA assets to Roth IRA assets, right? So this is something that needs to be done before the end of the year if you want to take advantage of it for 2022. It has to be executed before December 31st. In order to be able to complete that strategy. And the idea is, I actually love this strategy right now. Again, it's very specific to the individual. Just don't go out and haphazardly do it. You really want to take into account tax impacts, tax ramifications, portfolio impacts, allocation. There's a lot that goes into this decision. But the idea where the market is down, again, think about what we did during the COVID years, reaching out to clients proactively, saying, look, the market's down 15, 20%. Let's convert IRA assets to Roth IRA assets. In your case, one, because it makes sense, but two, the market's down. Mm-hmm. So you're taking taxable dollars, taking them out and buying tax-free dollars at a discount. So as the market recovers, which side of the ledger do you want to recover on?
Absolutely. You want that recovery to happen on your tax-free funds, to say the least.
And that's kind of the thought process behind this is, again, lemons into lemonade. I mean, there's nothing better long-term, in my opinion, than growing money tax-free. And if we could take advantage of a down market, buy assets that we like at a 10, 15, 20, 30% discount, and then see those assets recover over 3, 5, 7, in some cases 10 years because clients don't need that money, that's a nice win.
Well, I mean, that's the thing. I mean, 2 points I want to bring up. I mean, the first is the fact that, as I said earlier, about how the bear market, this is like our first bear market, extended bear market in at least 14, 15 years, right? So I was kind of joking around with the clients about, okay, when this happens, like a year like 2022 and end of year planning, you kind of have to dust off your bear market playbook. Like, I haven't had to use this in a year, right? In years. So then you open it up, and the first thing you see that we're talking about is tax loss harvesting. Looking at your positions, finding out which ones you can swap around, stay invested, but at the same time harvest those losses to use both against future sales or against any type of current sales of property that you do. Line number 2 is Roth conversions, taking advantage, as you were saying, of buying funds or money at a discount and having that recovery occur, in your tax-free dollars, or when the market eventually does recover, it's happening in your Roth side of the ledger, as Keith was mentioning, than on your IRA or your pre-tax dollars. Because basically, if you leave in the pre-tax dollars, or if you miss opportunities like this, then all you're doing is really enriching Uncle Sam, because now you just have more IRA dollars that are going to be subject to RMDs and everything else.
And again, this is a strategy that should be looked at by your advisor, or if you're someone that likes to handle it themselves. It's important to visit these strategies because these opportunities don't come along that often. Again, we've seen 2 in the last 18 months.
Yeah.
With COVID, sadly, and then with this. But, after this bear market, let's hope we have another nice, decent market run, and we aren't talking about this type of stuff,
Well, and I think, too, it also, because you mentioned earlier about the planning nature of what we do, I just love how, here we are, sharing the podcast, and we have a couple other strategies and tips for folks, at end of year planning, but here we are talking about tax planning.
Right.
We can certainly talk about investments, and we can get into the market and where we see the market going, in 2023 and whatnot. And certainly, it's a whole other subject for another day. The point being is that, as you were sort of referring to it, it's like, we really hope that people, if they have an advisor, that they are receiving this level of planning, because clearly you need it. Clearly everyone needs it and deserves it, to make sure that they are taking advantage of opportunities, because now we are sort of combining, again, tax planning with a little bit of investment planning, being aware of where the market is, of course, but then making sure that you are leveraging and using every last bit of energy and effort to make a very difficult situation that much better. I think you also referenced it earlier, Keith. I really got to, kind of made a note about it, is the fact that our jobs, as you were saying, is make sure that our clients don't miss opportunities or take advantage of that. Because certainly they're looking to us as to, okay, what do you do? What do you do? What should I do during these difficult times? Mm-hmm. And if we as planners, and anyone that either does it themselves or has a planner, kind of looks at it in a cool head, doesn't get caught up in the news and the emotions of it all. It just says, okay, all right, what's the best way if this were to happen? In knowing what I know now, or whatever in the future, like what would I tell my clients? And so it's things like this. It's tax loss harvesting, Roth conversions, and then let's go with a couple other last little tips for end of year. So we got tax loss harvesting, we have Roth conversions, and what else are you telling your clients at the end of the year?
Just make sure if you have the ability to do so. Obviously, times are tough, inflation's high, the dollar's not stretching as far right now, but are you able to max out your contributions to your retirement accounts? Mm-hmm. Are you, that includes, IRAs, 401ks, 403bs, HSAs, all these different accounts. You want to be able to get that money in there by the end of the year if possible. So revisit that, make sure that, if you have the ability to do so, you are doing that.
Well, and just to pause, I was going to say, because we'll go back to the other thing, just to mention about how, just on the 401k front, so I just want to go back to that, because there could be free money on the table.
That's right. You got to get the matches.
Yeah, if there's a matching program that you're receiving from your employer, you absolutely need to make sure that you are maximizing your contribution and maximizing the match that you may have.
Yeah, I had a new family come in over the last month, and they weren't making that contribution to that point to get the full match. And I was like, they're like, what's the first thing you would do? I said, that's the first thing I would change right there, because it is free money. Mm-hmm. It's money that the company's giving to you just by putting money into the program. So that's the first adjustment that we made with them, was making the adjustments in regards to the contribution, so then they hit that level, so then they get that match.
And by the way, this goes for any year whatsoever to make sure that you're getting your match in and your free money, but specifically in 2022. I mean, we're talking about having, doing Roth conversions and tax loss harvesting, but just to go back to Roth conversions, well, we're really, big on it. Again, for individual situations, you have to implement it properly. But at the same point, the whole goal is, okay, if the recovery happens, we want the recovery on our Roth IRA side of things. But here it is in regards to contributions, also extremely important in 2022, because you're buying low.
Exactly.
I mean, now is the time that you want to get that asset to work, because things are as cheap now. And what were some of the numbers that we saw? Like the market is basically where it was in like early 2020 or something.
Yeah, I think the Nasdaq's down over the last 2 years.
Yeah.
Think about that. If you invested 2 years ago, you've lost money in the Nasdaq, which is, it's a little bit more risky, a little bit more high tech weighted, but I mean, it also can grow quite quickly.
Yes.
So,
right.
That's an interesting statistic to look at for sure. I think one of the last things that people could also do is every year at the end of the year for folks 65 and older, right, is open enrollment. Mm-hmm. So a lot of folks just kind of coast and kind of relive and just kind of keep with the same Medicare program, right?
Yes.
Which is fine if you're comfortable with that and things like that. But every year in November, there is a period of time called open enrollment where you can look at your Medicare program, your Medicare supplement, your Medicare Advantage, whatever program it is that you have to go alongside Medicare and make the proper adjustments for the next year. Sometimes that can be a missed opportunity for folks. Mm-hmm. And the window closed and they're like, oh, I should have done that. So we just want to make people aware that now is the time. It's not convenient because this is the holiday season, but now is the time to visit and revisit these types of things and take advantage of the opportunity that's in front of you. And really, again, goes back to planning. We talked about taxes, we talked about healthcare, investing in the down markets. These are all very important strategies that, should be discussed, should be visited with clients.
And just to go back to Medicare, just so everyone knows, I mean, the beauty of the Medicare situation is that they're individual plans. So meaning that a husband can have one plan and a spouse can have another plan. And so, because at times, and I think we're all quite aware that everyone's health is obviously different, and
Absolutely.
we age differently, and what happens. So there's very often that we will have, I'll leave it whether it's the husband or the wife, but one of the spouses that are sicker than the other, well, they certainly should have a much better plan or more robust plan. Whereas if there's the other spouse that's very healthy, they could have more of a catastrophic plan.
Right.
Again, if they so choose. But so it's good to know that it's all individual plans. But then to kind of go back to what you were mentioning too, Keith, and just how it's all interrelated is because, all right, well, obviously when you look at your health insurance and your open enrollment period and whatnot, you're certainly taking a look at your budget. You're taking a look at what is affordable and what's not affordable, right? So you are looking in the big picture of things. Now that's just one small piece of a big picture. And so we truly hope that people are receiving that type of comprehensive advising, whether it's on end of year kind of theme, which I'm going to recap in a moment, or whether it's something that, as I said about how, healthcare affects your income and how your retirement plan, i.e. 401ks and 403bs, obviously are affected by market conditions. So these are I just truly hope that people are receiving this level of planning and this comprehensive nature, because especially in difficult years, as I said at the very, very beginning, we don't want people just putting their heads in the sand, just saying, okay, I'm just going to pick my head up when it gets better. It's like, no, it may not get better for another year for all we know. And if we're missing opportunities and if we're missing deadlines, then people are missing out. And so that's really what at a core of our job here is to make people aware. So in review, in regards to end of year planning, there's probably other stuff too, but here are kind of the big ones. Of course, tax loss harvest. Again, if you do have any type of after-tax dollars, brokerage accounts, or whatever that may be, really make sure to see if there's any losses that you can harvest. Make a sale, but then stay invested and avoid the wash sale, as Keith was mentioned. But look into what's called tax loss harvesting as a way of offsetting your current taxes and potentially your future taxes. Also, Roth conversions. I think there's a lot of confusion. Sometimes people say, oh, I can't do a conversion. It's like, no. You might not be able to do a contribution to a Roth, but you can absolutely do a conversion. And the idea is that, okay, I'd rather have the recovery happen in our Roth IRA dollar than our traditional IRA dollars, or I'd rather have the recovery happen in our tax-free bucket. Of course, same idea. Everyone's situation's different. Everyone's income's different. So you have to be very careful in regards to just broadly doing a Roth conversion. But again, something else to explore. And then the last two are topping off your retirement contributions. Again, specifically because 2022, great time to buy low. And last but not least, making sure that you are aware of the open enrollment with the Medicare program, and just not missing that opportunity to make a change to your coverage if it warrants it at this point. But Keith, thank you so much for giving us the tips that people will take away from, and certainly I'm wishing everybody a much happier and more fruitful 2023.
Thanks for listening to the Retirement Roadmap podcast by SHP Financial. If you've enjoyed today's episode, be sure to hit the subscribe button so future episodes are automatically downloaded directly to your device. And if you've liked what you heard, please share the show. Create your own little ripples so we can help even more people with their retirement goals. If you want access to all past interviews, including notes, resources, and exclusive content from SHP Financial, visit shpfinancial.com/podcast. Thanks again for joining us on the Retirement Roadmap podcast. And for all the attorneys out there, and disclaimers and disclosures, I'm just going to put on my super serious voice and add our own. No statements made during the Retirement Roadmap podcast shall constitute tax, legal, or accounting advice. You should consult your own legal or tax professional on any such matters. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk, and unless otherwise stated, are not guaranteed. Our investment advisory services are offered through SHP Wealth Management, LLC, an SEC-registered investment advisor. Insurance sales are offered through SHP Financial, LLC. Our advisors and insurance reps may offer clients advice and/or products from each entity. No client is under any obligation to purchase any insurance product.